I'm not a financial advisor. This is not financial advice. Please do your own research. Welcome to the Vinny G Markets channel, brought to you by Vinny G Money. Now, the markets have been down this past month, and I just wanted to put out a video explaining why the markets are down and what we could expect moving forward. But getting right into it, we have the S&P 500 for the week, down almost 2%. For the month, it's down almost 10%. The Dow Jones for the week is down around 1.6%. For the month, 5.57%. And the Nasdaq down the largest, down 3.1%. For the week, and for the month a whopping 15% down. And we'll get right into our indicators. We have the US 10-year Treasury. You see it's been rising over the past month at 2.93%. This is high. We're not above 3 yet. We're just pricing in Federal Reserve rate hikes. We have another Federal Reserve meeting this Tuesday and Wednesday, and that's what this is all about. They're pricing in another rate hike. That's why I'm not concerned about the US 10-year Treasury being this high. One, it's not spiking. Two, and we're pricing in rate hikes. Another one which is going to be this week. We'll get into that more later. We'll look at the US dollar index. Again, the US dollar index, we do see it rising to its current level of about 103 and change. And the reason why I'm not concerned about this is because there's turmoil going on in the rest of the world. So the US dollar is the safest currency compared to the other countries' currencies. So this is the reason why it's rising. If there was no world turmoil and the US dollar index was rising like this, I would be more concerned, but the fact that we do have turmoil, to me this is just normal fluctuation. And now we'll pull up our third indicator, our heavy hitter, crude oil, back at around $105. I don't want to spend too much time on this. We have a whole video dedicated as to why the United States tapping into their strategic oil reserves was going to do absolutely nothing, so you could check that video out to understand the price action of what we're seeing now. But I wanted to spend this video just going over the stock market movements and what we could expect moving forward. So let's first pull up a yearly chart of the S&P 500 to show an interesting support level that we've been hitting. It's around this 4100 range. You see that we hit it almost last year, and as of recent as well, it's around this 4100, where if we hit it, we typically bounce back up. We might dip below it a little bit before it bounces back up again. So we do need to keep a close eye on whether or not we're going to bounce back up off this level. If we continue to dip below this support level, it could mean that there's more pain ahead for us in the stock market. And even though this is not really technical analysis, you know I don't like looking solely at technical analysis, especially when it's going over where the overall market is going to move to. But just like our market turbulence made simple video, we do have the same two factors that's going to decide what the market is going to do going forward, and that's the Federal Reserve decision on what they're going to do with interest rates this week, along with the Russia-Ukraine situation. Is it going to escalate? That's the reason why the market's been down big time this past week. We'll get into that more. But you know, on the Vinny G Markets channel, we keep things simple. If you're following the lamestream media, they're tossing all types of confusing news out there. The stock market, it's going to move based on only these two factors, the interest rates and the Russia-Ukraine situation. And the easy thing is, the interest rates we already have down packed. We know the Federal Reserve, they're going to raise the interest rates by 50 basis points this week. I don't even need to spend too much time on that. I think the market knows this already. It's been pricing in a 50 basis point rate hike this week coming up. But this meeting is still important because we need to take away two key factors from this meeting. One of them is their future guidance. And what I mean by that is, when Uncle Jerome gets up there, is he going to say we're going to continue increasing the Fed fund rate at 50 basis points per clip, or are we going to ease it back down to 25 basis points? If he gives indication that we might move back down to 25 basis points per clip, the markets are going to like that. It's going to show that they're not going to be raising rates aggressively, and the markets would view this as a positive thing. And the second key point that we need to take away from this meeting is what they're doing with this taper. We've been over this in other videos. I don't want to get into it too much, but when we mention taper, we're talking about the slowing down and total discontinuement of the Federal Reserve buying bonds in their asset purchase programs. The Federal Reserve Reserve last year said they were going to start the tapering process well before they started raising interest rates. We know that's been a complete lie and joke. We left off that they were going to finalize the plans in May. So we'll see if they have any plans. I doubt it. So if there's no clear indication that the Federal Reserve is going to start tapering, the markets will also take that as a good thing as well, because again, that's still the continued easy money printing going on, and the Federal Reserve just keeping everything afloat as they have been doing since basically 2008 and as of more recent 2020. But still, the CNBCs, Bloombergs, and Fox News of the world might think a 50 basis point rate hike is still not going to be good for the market. The reason why I'm not concerned about it, it's still nowhere close to the inflation rate when we're raising these interest rates. Inflation, we have it set at around 8%. A 50 basis point rate hike this month is still nowhere close to that. Credit is still flowing, and we see this straight from the Federal Reserve website. We have total consumer credit owned. This is over the past 5 years. It's done nothing but go up. We saw a short instance in 2020 where it started going down a little bit, but like we went over in our other videos, there were programs that were created and it started the flow of credit again, keeping the easy access for people to borrow money. And also, we'll pull up the M2 money supply chart straight from the Federal Reserve website. We've been over this chart in a longer term view, but let's take a look at only the past 2 years. You see, within the past 2 years, we've done nothing but go up, even as of recent, and this is all because the Federal Reserve is still buying bonds and haven't tapered off of their asset purchases, and this is the interest rate game that they're playing. The Federal Reserve is telling you they're raising the interest rates to combat inflation, which is a total lie. If they really cared about inflation, they would have started with the tapering process already, even before they started raising interest rates, because with them raising interest rates and not tapering, it's only hurting the average person. The average person is still borrowing money because the money is out there and the credit is out there. You're just now going to be paying back that money at a higher expense because the interest rate is going to be higher, and because the Federal Reserve is still printing money, prices are only going to go even higher. So you're buying things at a higher price with a higher interest rate, which means that's more money out of the average person's pocket to pay off these things. A perfect example is housing. Even though mortgage rates have skyrocketed, the prices of houses are still soaring because too much easy money and credit is out there. So if you're looking to buy a house, you're only going to have to borrow more at a higher interest rate, which is a lose-lose for everybody unless you have that money, which most people don't, because we already know that people's real wages aren't nowhere keeping up with inflation. All at the same time, the United States economy continues to shrink as GDP falls at 1.4%, and on top of everything, we have nothing but crisis after crisis popping up. We have an energy crisis, a food crisis, and we're on the brink of war, and the answer to all these crises is to throw more money at it. So with the United States economy shrinking, people still hurting money-wise because inflation is still out of control, and now they have to owe more money as interest rates rise, and all this could lead to the Federal Reserve slowing down the rate hike increases back to 25 basis points, along with there being no taper in sight, and these likely scenarios would be beneficial for the stock market because the healthiness of the stock market is derived from the debt market, and with all these scenarios, the debt market will be fine as long as the Federal Reserve slows down their interest rate raises and we still continue printing money. And the mainstream media won't tell you this, but on the Vinny G Markets channel, you know we keep it real. All we're really seeing is a game the Federal Reserve is playing. They want to see how much they could raise these interest rates and have people borrow money at the same time, because you know their main goal is to eliminate the middle class. So when they make it more expensive for people to borrow, especially when people are relying more heavily to borrow money just to maintain their status and keep up with regular personal goods, that's how they could put a further burden on the people while keep the stock market inflated all at the same time. And this mechanism will have inflation continuing to run hot with no end in sight. Again, when it comes to inflation, we haven't seen anything yet. And that brings us to our next main focus on what's moving these markets, and that's the Russia-Ukraine situation. And just like our Market Turbulence Made Simple video, we're being hit with the double whammy. We got the Federal Reserve raising rates again this week. At the same time, Russia-Ukraine situation seems to be escalating. A lot of these escalations were happening late Thursday into Friday, and it's no coincidence. That's when the stock market was taking the biggest hits, including the biggest hits of the month. And you could see again in all three of these charts that the biggest dips were happening this past Friday. The S&P 500 down big this Friday. Same thing with the Dow Jones, and of course, same thing with the Nasdaq. But this is what's been going on this past Friday. We have Russia sharpens warnings as the US and Europe send more weapons to Ukraine. At the same time, Biden asks Congress for new aid package. Putin warns of further retaliation. Also, we have Russia attacks, I believe this is pronounced Kyiv, as UN leaders visit and onslaught continues in eastern Ukraine. So a UN leader was in the city at the same time Russia was attacking. And we have US sees no threat of Russia using nuclear weapons despite rhetoric. But let me tell you, rhetoric is all the stock market needs to hear. And just like we stated in our Market Turbulence Made Simple video, any type of escalation or expansion of this war, it's going to be negative for the stock market. So just like we always do on the Vinny G Markets channel, we simplified everything on what we need to look for the markets going forward. We have to see if we breach that support level around that 4100. If we continue to dip, we need to see what the future guidance is on the Federal Reserve rate hikes going forward in the meeting this Tuesday, Wednesday. We need to pay attention to the Russia-Ukraine situation to see if things escalate or expand, and we need to continue to monitor our three indicators, most importantly that US 10-year Treasury, because that's going to be the indicator that tells us when the debt market is having problems. So even though we've had a pretty terrible month, I still don't see this as a major market crash. Reason being that US 10-year Treasury is still stable and the Federal Reserve is continuing to print money. But with that said, it was a pretty terrible month for the market. It's almost impossible to avoid any type of red. But going over how we've been positioning ourselves, crude oil is actually up for the month. Energy, depending what you were in, the sector is overall down, but still one of the better performers. Commodity ETFs, we'll take a look at basic materials, basically middle of the ground. Defense contractors, they've been holding all right, unless you've been invested in Boeing. That's the only real dog here. All the others, even though they're red, they've been holding their own. And like we discussed in our last video, getting exposure to food and agricultural ETFs, and a lot of these were up for the month while the overall market was down. Take a look at these tickers. We have wheat, WEAT, up for the month, and we have tags, TAGS, also up for the month as well. And the big banks continue to underperform, but because the overall market was down, it was just inevitable that the big banks were going to go down along with it. But a lot of this is the concern of the amount of Russian defaulted debt that these big banks are exposed to. But big banks have already been granted the ability to write this stuff off. I think they have the total Russian debt default at around 14 and change billion, and they've been given the right to write off 15 billion already right off the back. And because we know that interest rates are going to continue to rise, at the same time the Federal Reserve not tapering, with those lines of credit still being given, that should benefit the banks going forward. So if looking to buy something off a pullback, again, I wouldn't toss my entire portfolio in it, but if looking to purchase something on a pullback that might perform and rebound over time, big banks isn't a bad option. So just to sum everything up, at the end of the day, the Federal Reserve and that US 10-year Treasury, those rates do continue to rise, but it's not keeping up with the rate of inflation. So those interest rate raises, it's not going to do anything to inflation. At the same time, we're still printing money and the Federal Reserve is still trying to buy assets. So what we're doing is we're trying to follow where this new money is going. And since we know we're heading into a global energy crisis, we have world needs extra 1.3 trillion energy investment by 2030, and this is by JP Morgan, and we all know that JP Morgan is tied to the Federal Reserve. You could just watch our past videos about that. And we also have Biden asks Congress for 33 billion in aid for Ukraine as war drags on, and we know this war is going to continue to drag on. Again, we're not going to discuss what's right or wrong. We just know this war is going to continue going and money is going to continue being sent into it. Another money spot we're looking into is US Treasury Secretary Yellen to meet with top finance ministers to address global food crisis. So you know world leaders, governments, and institutions, they're gearing up to toss money at this crisis, and all this explains why we're allocating in certain sectors, especially when it comes to crude oil, energy, defense contractors, and like we spoke about in our last video, those food ETFs. So the only thing I really see possibly bringing this market down is the expansion of this Russia-Ukraine war. If that happens, equities across the board could take a hit. But beyond that, I just like where we're allocating and trying to take advantage of this market. Again, we are still invested in those fourth industrial revolution stocks. Those will continue to take a hit. And even with tech in general, minus the big tech names like maybe Microsoft and Apple, tech, the NASDAQ, these high growth stocks, even cryptos, they're going to continue to take hits as the interest rates keep rising. That's why the NASDAQ is always lagging. So these high tech, high growth stocks, these are where you just want to invest little by little on its way down. Like if you come across some money, it's your birthday, your grandma hooks you up with a little something in the envelope, so you want to invest that money and you don't care what's going to happen with it in 3, 5, 10 years. Again, shouldn't be nothing significant. These are positions that we're just building on, but the bulk of our investment should be in sectors that we stated before on this video for those reasons we discussed. And I really don't see much changing going forward. So going forward, I do want to try putting out different types of videos, maybe videos going over options more, or discussing the crypto market more, or getting into specific companies when I'm talking about the fourth industrial revolution, and also within options trying to put together a technical analysis system that could lead us to good credit spread trades. As last month we did pull ExxonMobil, which would have been a good selection to sell credit spreads on, put credit spreads as we were discussing. But y'all know me by now, the next video might just be another market updates video, but even with those, you getting raw uncut material where we exposing the markets, putting money in our pocket. So come mess with your boy. If you like what you hear, Hulk smash that like button. And as always, I'll leave you off with this: the God of the Bible, the God of Abraham, the Father of our Lord and Savior Jesus Christ is real, and may he bless you.
Well, the Russia-Ukraine conflict has given rise to frequent headlines of spiking global food prices. The prolonged war has disrupted supplies of many staples, specifically one that's used world over, wheat. Given that the two regions contribute to 30% of the world's wheat production, supply was under pressure when the conflict began. Remember, Russia is the world's largest exporter of wheat, with Ukraine in third, right behind the United States. Low stocks, fertilizer shortage, and rising input cost in other major exporting countries, in addition to the war, has resulted in vacuum in wheat supply globally. India has stepped up to plug these supply gaps in the face of ever-rising demand, already agreeing to export to the world's biggest importer, Egypt. When you look at these numbers, you can see that there has been a constant increase in India's exports from 0.49 million tons in 2019-20 to nearly expectation of 12 to 15 million tons in this year. 7.85 million tons was a record export already, and we are looking at an even higher number in this year. However, that has strained domestic production, private buying to cope with exports, which in turn has pushed prices in India above MSP. Production is also in jeopardy as an intense heat wave has hurt sowing levels as well as the crop itself. This, in addition to an output similar to last year in the face of rising demand, has led to fears of an acute wheat shortage within India. Almost so that we might be turning to imports by the end of this year from the kind of export numbers that we're looking at this point in time.